And welcome to the Cold Start Corner for part 2 of this 3-part series we are calling Practice Valuations 101, where we are demystifying the world of practice valuations. Now, you'll recall in part 1, we kicked it all off by exploring financial statements. But we didn't stop there. We took it a step further and we actually reconstructed financial statements and even went so far as to calculate some of those earnings basis measures. And by the way, if you are joining us for the very first time, you can find all of these calculators and simulators that I'm referencing in the Cold Start Corner at Akrinos.com, where you will find right there everything you need to actually recreate your own financial statements and calculate these earnings basis measures. So if you hadn't done that, go back, watch part 1, and get through those exercises, because that is going to set you up for this episode, part 2, which is all about modern methods and applications. So what we're going to do today is we're going to take those reconstructed financial statements and those earnings basis calculations, and we are now going to apply them to modern valuation methodologies. And that all is going to serve us up for part 3 coming your way, where we're going to pull it all together, aggregate a practice value, but more importantly, provide you with guidance on where to go from here in bringing that practice purchase vision to reality. So let's go ahead and jump into it today. And as we start exploring modern methods and application for practice valuation. So business valuation falls into 3 general approaches. There's going to be the asset-based approach, the market-based approach, and the income-based approach. And we're going to start our conversation today by exploring the asset-based approach. So please, as you're following along, make your way over to the Cold Start Corner at Akrinos.com and get ready to use some of those simulators here. So we're going to kick it all off with the asset-based approach. And the asset-based approach to a practice valuation considers the underlying business assets in order to estimate that value, right? So, this approach is going to rely heavily upon the principle of substitution, right? And it's really a matter of like, hey, what would the cost be to recreate the business, the practice that would create, comparable economic utility, right? Now, under the asset approaches, there are 2 primary approaches. There's going to be the asset accumulation approach, which we do not use at all in eye care and small business. Think of your asset accumulation approach as being for big capital intensive industries. Think like mining, petrochemical refineries, and what have you. However, there is an asset-based approach that is applicable to modern eye care, and that is going to be the capitalization of excess earnings. Now, what you're going to notice here as we go through these different modern methods is that each are going to pull on different numbers that came from those financial statements. So again, if you hadn't already, if you're just joining us in this episode, part 2, be sure to go back and start at point 1 to recreate those financial statements and calculate those earnings basis measures. That being said, here, as we're calculating that capitalization of excess earnings, again, this is going to draw on items from both the financial statements and, from both the income statement and the balance sheet, as well as some of those calculated earnings measures. So specifically, to calculate the capitalization of excess earnings approach, which again is a novel asset-based approach used in modern eye care, you're going to want to look at the cash flow forecasted growth rate. You're going to also want to look at the cash flow and the net income. Those are going to be your key variables from the income statement. And then you'll notice from the balance sheet, it's going to take into consideration total equity, as well as total current assets less inventory and the current liabilities. So again, you can find all the simulators right there at the Cold Start Corner on Akrinos.com. So the capitalization of excess earnings measure is doing just that. It's capitalizing the excess earnings that those assets are producing so as to come up with a present fair market value today. That's the extent of utilizing the asset-based approach. Again, the asset accumulation approach is not suited to small business. So next to the asset-based approach, then we're going to get into the market-based approaches. And market-based approaches really target to derive a business value by consulting the marketplace, right? So look for different indicators of that market value. So here, most commonly, we are looking at industry benchmarks, right? Studying industry benchmarks to collect comparative evidence, right, to use in estimating this. This approach also really leverages the economic principle of competition when estimating value. So this is where you'll start to see where you're really looking at how the practice performs in comparison to its peers. So how does this eye care practice, how does this optometry practice compare to other optometry practices? But also, this is where a local market research and local economic trends can also have an impact on the value. So here, there are two primary methods that are being utilized in the market approach. Those are going to be the comparative transactions method and the rules of thumb method. So again, go ahead and toggle over to the simulators there in the cold start corner at Akrinos.com. And you'll find that the calculation methods for each of these is rather straightforward. Comparative transactions, pretty simple. It's looking at gross revenue, net sales, and EBITDA. Again, if you're looking to calculate those, go back to part one and reconstruct those financials that you're assessing, and you'll be able to arrive at that EBITDA figure as well as that net sales figure. So again, practice value using comparative transactions is all about being one of these market-based measures. It's really going to compare this practice performance to other optometry practices. But it doesn't stop there, right? Because then the other big method used here when we're talking about these market-based approaches is going to be industry rules of thumb. And this actually, I suppose, has become one of the more common pieces here in recent years, particularly because this really embraces that concept of EBITDA. So here, again, if you access those simulators in the cold start corner at Akrinos.com, you'll see the key variables. That's going to be the net income. That's going to be the owner-operator salary, as well as the replacement of owner-operator salary. For more insights on that, again, reference part one, where we are reconstructing the financial statements and calculating earnings basis measures. So again, getting back to industry rules of thumb, you're utilizing net income, owner-operator salary, replacement of that owner-operator salary, also your depreciation, amortization expense, interest expense, and taxes. Those together are going to deliver you to your adjusted EBITDA. But this is where things get really interesting and why we say industry rules of thumb. And you'll notice that different industries have different rules of thumb, because this all boils down to what is the multiplier that is then going to be applied to that EBITDA. So you will notice there in the models there at the cold start corner at Akrinos.com, the EBITDA multiplier is 4.25. But again, we've left that there as a variable that you can feel free to play with yourself. So to wrap it up here, this little segment, right, where we've touched on these the market approach evaluations, again, the comparative transactions method, which is looking at your gross rev, your net sales, and your EBITDA, and then the industry rules of thumb, which takes that EBITDA a step further and really starts to apply these industry-based multipliers to it. So moving right along, again, here we're talking about modern valuation methods and applications. We kicked it off by talking about the asset-based approaches, but specifically that capitalized excess earnings method. Then we just discussed the market-based approaches, the comparative transactions method, and industry rules of thumb. And now we are getting to the income-based approaches. And income-based approaches is all based on the economic principles of future expected return. So this is truly all about looking at that practice as being a machine that prints money. We like to use the analogy of comparing an eye care practice to an ice cream shop. Why? Well, everybody kind of likes ice cream, but it really gives us a good idea or a really good perspective of looking at these as just that, businesses, right? So it's important here when we are assessing the income approach, right? Again, we're looking for estimating the future returns of the business, right? and discounting it back. So you'll notice there's actually a few different methods that are being used here, but it's all centered around what is that practice's ability to produce a profit. So three particular approaches that are used here, or methods that are used here, is going to be the discounted cash flow method, the multiple of discretionary earnings method, and the capitalized earnings method. So again, I'll invite you to toggle on over to the simulators we made available there at the Cold Start Corner at Akrinos.com. And go ahead and check them out. So you'll notice the first one is going to be that discounted cash flow method. As far as the key variables that are in consideration here, it's pretty simple. It's going to be net cash flow. It's going to be that cash flow forecasted growth rate. And it's going to be the equity discount rate. So what we actually do is we then create that net cash flow forecast, and then we discount it back to arrive at what that valuation is going to be today. Again, utilizing the discounted cash flow method under the income approaches. So method number two with the income approach is going to be the multiple of discretionary cash flows. Key variables here being net income, that owner operator salary is going to surface again, depreciation and amortization expense, interest expense, and taxes. Now, from here, in one side note, if you're following along here, you may notice that we did not include the replacement of owner operator salary when calculating the multiple of discretionary earnings or multiple of discretionary cash flow. Reason being, multiple of discretionary cash flow looks at a sole owner operator. So we're not looking at this from a standpoint of replacing the doctor. So this really looks at it from the standpoint of the total net cash flow benefit to a sole owner operator. So that being said, again, we're factoring in net income, the owner operator salary, depreciation and amortization expense, interest expense, and taxes. We will mesh those together, run those through the math. By the way, you can investigate a bit more on the math. There's actually some really great online tutorials through a variety of different sources that you can get to kind of understand the mathematics behind the stuff. But ultimately, the goal here is that we're gonna arrive at what this seller's discretionary cash flow looks like. And then here in this multiple of discretionary cash flows calculation, we're then going to apply an earnings multiplier to it. Now, the earning multiplier is where you get into a lot of these practice specifics, right? So you're basically going to be rating the practice on a scale of 0.1 to 3.0, where 1.5 is going to be the median average practice, right? So if you're talking about a practice that, perhaps, I don't know, let's just take one variable that you'll be looking at. You'll definitely want to look at, say, the tenure of the team, right? So if you're considering purchasing a practice and they've got high turnover, that earnings multiplier is going to be impacted. Comparatively, if you're looking to purchase a practice and they've got a very well tenured team and really strong culture with little to no staff turnover, that earnings multiplier is going to boost up, right? Again, a practice with a stable team with healthy culture is going to be valued greater than that practice that maybe has high turnover and questionable culture. So all of that goes into determining this multiple of discretionary cash flows. Again, you're arriving at the seller's discretionary cash flow and then applying a multiplier to it. So now, hopping on over to one last calculation here regarding the income approaches to practice valuation. That is capitalized earnings. And here's pretty simple. Looking at net cash flow, the net cash flow forecasted growth rate, and the equity discount rate, and capitalizing those cash flows around the capitalization rate that does capture both that growth and that equity discount rate of the practice. So when we put it all together, what we've done, and I don't know if you realize this, and if you're just listening to the audio as you're driving or doing something else, definitely make your way over to the Cold Start Corner at Akrinos.com, because what we have just done is actually created some valuations around the 6 most common modern business valuation methods. So that all then sets us up for episode 3. Because in episode 3, what we're going to do is we're going to take each of these 6 approaches each of these 6 methods that we've calculated through, we're going to aggregate them all together to come up with this enterprise value for that practice, and then provide you guidance on where you go from here in bringing that practice purchase vision to reality. So if you got questions or comments, please do head on over to Akrinos.com. Feel free to shoot us a message, contact@Akrinos.com. If you haven't already, be sure to follow us on the socials and subscribe to our YouTube channel. On behalf of all of us here at Akrinos, Erich Matei signing off.